well, I know people are going to start kind of still coming in, but I'll go ahead and just give a little bit of a brief background. So I am really happy to be here. This is my first time at one of the New York State beer summits. I have an accounting firm. My focus is working with breweries and tap houses on all the back end operational stuff. So kind of like outsourced CFO, working with people. I'm bi-coastal. I've got an office in Washington State and in Richmond, Virginia, and I work with clients across multiple states. So it's always fascinating to me to see more about what's going on in different state environments. But the goal for this presentation is to appeal to wherever you're at. I think you'll be able to get some good pieces of information, because I'm going to approach it a little bit differently. One of my goals is between owners and managers and staff starting to bridge the gap a little bit in what we look for and why we look for it or why we are paying attention to it in business to help everybody succeed. And whether you are just starting out as a brewery or you've been doing this for a while, I think there's different ways of thinking. As we heard in the opening session this morning, a lot of it is looking at our mindset and how we're viewing things to start to see what other opportunities are out there, because they're definitely there. It's just a matter of how we find ways to power through it. So the things that I'm going to go over, and for me, my focus and background is I've been doing this just shy of 30 years now in the accounting industry. I've had a niche within craft beer for about the past 10. I had started out more with a construction and real estate background, which then worked into craft beer when I had one client that got into doing more tap houses and breweries, and they really blend well together because you always have to deal with construction and real estate issues when you've got a brewery through your build outs or a tap room or anything. So today in our short time together, I'm going to walk you through a case study of what happens when you get pretty focused on looking at certain things in the business that might not be everything that you should be looking at. What happens when we do that, and then what you can do to right the ship, which doesn't always happen overnight. But we're going to walk through a case study. We're going to redefine what cash flow really is and what it means, and a few little pointers. I mean, that can be a topic in and of itself. And I know that there's quite a few finance topics that are at this conference that you'll hear different strategies, but I wanted to leave you with a few things to think about cash flow just a little bit differently. We're going to go through mindset and reasoning, where owners are, but also managers and employees, and how that's affecting all of the results that we're getting within our business. And a couple of tips on how we can manage a little bit more effectively. So this is probably not anything new, but especially post-COVID, and even pre-COVID, the line of success and what we have to go through in any realm of owning a business or even within our jobs is all over the place. And there's going to be setbacks, there's going to be problems. It's how we choose to approach them, and really looking at adapting to the fact that it's not always going to be super easy. So I always like to preface my talks with that graphic. So let's start with a case study. So typically what is common, not always, but what is common in business is that people are looking at their bank account and cash balances first thing. And cash is definitely king in your business. That's probably the primary thing. People are usually looking at sales, both in dollars and also counts. They're looking at your production counts, seeing things. You're looking at customers in some fashion, depending on how you're using your point of sale. And as you grow, we hopefully get people into, at least at the owner level, looking at a balance sheet and a profit and loss, so that you have a general idea of what's going on. That's generally what people look at. So this particular case study, we've got some historical data here, and I hope you can see the numbers okay. What we have is a business that start back in 2018, they were doing decently. They had some sales, their net profits were decent, and then there was some new competition that came into the market. And we see this quite a bit. You know, you get a brewery that'll open just around the corner from you. And in this particular case, they decided, because there was so much new competition, that they were going to compete on price, which is very, very common in business, that people will choose to discount their prices in order to maintain their volume and get people in the door. So in 2019, that's really where they were seeing the effect of the new competition. Their sales were dropping, their cost of goods sold actually went down a little bit, because you know there's a correlation to your sales that's going to come into play, and ultimately their net profit was starting to go down. So their choice was to compete on sales, and the business owner came in and said, hey, wait a second here, our sales are down. They're looking at the end of 2020. Now mind you, 2020 is when COVID hit, so you're also dealing with a whole other element. But setting some of the more specific pieces of COVID aside, in 2020, their sales were down. So what happened was they were competing on price, and they were able to maintain a volume even with COVID, so that their sales were down 65,000 from 2 years ago, but only 5,000 from the year before. So they thought, well, we're doing really good. Our team's super busy. We've got to be winning here. But the business owner's going, hey, wait a second here, my costs are skyrocketing and my net profit just tanked. Our team is busier than ever. What's going on? I don't understand why, I don't understand what else I should be doing. The numbers just have to be wrong. Often we hear that, is that when something's not quite making sense, the numbers just have to be wrong. But numbers generally don't lie. So what we need to do is we start having to read between the lines a little bit. That's the key, is that your numbers tell a story. And the goal is to start understanding your numbers more and looking at them as, what is the story that it's telling you? What is the story that it's telling third parties? Whether that's your employees, whether that's your vendors, your bank, other investors, and how do you want that story to shift? So again, new competition arrives in 2018, 2019 they were cutting prices aggressively, and the sales were being monitored on a weekly basis, because that was what they were paying attention to. They were competing on price, they were monitoring on price. Well, what we need to do, like I said, is we need to dig a little bit deeper. One of the key pieces that is very important when you start looking at your numbers is it's not just about looking at dollar values. It's really important to start looking at it on a percentage basis, because sometimes what seems like a big or little adjustment when you're comparing dollar to dollar on a percentage basis could be a lot more significant or less significant. So one of my pointers would be to always look at things not just with dollar values, but on a percentage basis. So one of the key things that we look at here is, what's the trend in the percentages between cost of goods sold, gross profit, expenses, and your net profit. And what you'll see here is that in line with trying to compete and getting a lot more people in the door, but your sales don't necessarily they're not representative, you're going to have your cost of goods sold go up. Now 2020 we saw price increases anyway, so there was that element. But if you've got more volume but less revenue, it's going to make that increase in that percent a lot greater. So what they were actually seeing was an extra 5% hit to their cost of goods sold that was translating to their gross margin. And their expenses also went up because they were doing more advertising, all of these different things. So one of the suggestions is take this data and let's look at it even more. And this is what's key in the information that you're looking at. Often what I find is your point of sale is a gold mine of information that far too many people don't use. And it's probably one of the areas where working with your team to understand why it's beneficial to them to take a little bit more time and design the point of sale so that you're getting really good beneficial reports. I have clients that use a multitude of point of sale systems, and we're pretty heavily integrated in it to know which ones are a little bit stronger in reporting than others, but definitely use this. So what we did is we said, let's take, as a first step, let's look year by year at the number of transactions that we're going through your point of sale. Now your number of transactions is going to be heavily dependent on how often you encourage keeping tabs open. If you are a place where you really encourage counter service, they come up and they're paying every time they order a beer, you're going to have a higher number of transactions that's going to skew your ability to some extent to determine how much a particular customer is buying from you in a particular visit. So the number of sales though, or the number of transactions that are going through your system is a key piece of information that everybody should know. So if you look at that number of sales, from 2018, they were sitting at around 40,000 a year. By 2020, yeah, they were definitely busier because they grew by almost 50% volume in the number of transactions hitting the system. Now, customers is also something that some people start to track decently within their point of sale system, but a lot of people don't. But if you take the number of customers that have seen you during the year, and then you can use that information to give us some further analysis. So what's interesting is the number of customers was less back in 2018, as we would expect, and that didn't quite double, but it grew significantly. So what we're looking at in the midst of this, and I don't really have a clicker, but revenue per sale. If you take your gross revenue and divide it by that number of transactions that's gone through your point of sale for the year, you'll look at 2018, they were at $20 per sale, and they dropped to $12 per sale. So that's also saying that these people, when they're spending, they're not spending as much. Your gross profit, of course, is almost cut in half. Your sales per customer is going down, and then the number of visits per customer. So this is the information that we want to start to look at to develop some trends. So what happened is, like I said, they gained new customers. They were compromising value for price because they were no longer trying to set themselves apart as why you should come do business with us or what that customer experience is, like they talked about this morning. And they were creating 10 times more work for their entire team and more stress because ultimately they didn't have the customers that they wanted to do business with. And that's the thing, is that it's not always about just taking anybody, it's taking the people that value what it is that you're providing and giving a good experience, because those people are willing to pay. And that's been the thing that we've seen as a commonality post-COVID, even during COVID. If people truly value what it is that you have to offer, if you're pricing an $8 or $9 pint, they will still pay it because they truly value what your product is. So what we look at is, you'll see that percent, if adding in those percentages like we talked about, really again changes the perspective. You can see it a little bit more clearly where there's issues than just the numbers. So ultimately, once you have this information, the real question is, and this is where most people are at still right now, is how do we right the ship? So we are in a post-COVID new reality. We're still trying to right the ship in many ways. What do we do with it? So in this case, they started doing things differently. In 2021, they said, okay, we're going to change our pricing structure, not to price based off where the market is at, but what we need as a specific gross profit to meet our business goals. So they picked the margin that fit what they needed for their overhead, and this is something that you can work with your accountant or bookkeeper or whatever person that you're working with, or do some of your own analysis, but figure out where your gross profit needs to be in order to then back into where your prices are. Based off of how much volume you want to be doing. You can also be taking into consideration where your capacity levels are at and what you're producing, and if you've been operating at capacity or under capacity, and how that production capacity number correlates to the sales that you have or that you need. So they set their prices based off of what their margins needed to be. They really started tracking their customer information differently, and this is where explaining the what's in it for me to staff to help them do this with you. You know, it's going to take a little bit more time if you adjust your point of sale system or switch to a different point of sale system that makes tracking these things a lot easier. That's one of the benefits of Square that a lot of people like, is that it makes tracking customer information super easy. Not all customers like the fact that it's tracked as easily, but it gives you a lot of good information. And you can start asking for feedback. You know, that's something that we do in different ways, but really having the ability, for example, if you've got a bar, your beer tenders to be just interacting and taking the time to actually have conversations and maybe give them tasters of things for people who've been sitting there for a while. There's all sorts of different ways that you just get people interacting with you a little bit differently. You can even do what we call a customer advisory board, where you get, you know, a group of 10 of your regulars and you bring them in for one night on one of your slower nights and you host them and you just ask for their feedback. And it can be harsh at times, but it's a really good source of getting information about what they value and what they don't. Usually once you start asking them, they're very willing to share because they want you to be successful. Again, they chose to stop competing on price, and they also significantly changed discounts. And I will say that that's been something in the past year that we've been trying to promote sharing at more staff meetings, is the breakdown of where discounts and comps are coming from, how much of them are staff driven, and how much of them are, not just staff driven, but staff discounts versus all the different sources or reasons that you're giving staff discounts and comps, and really revisiting what's beneficial to the business, what you've been doing just because that's the norm, and how that can shift. And I'm not saying it's a bad thing to do any of those, especially for the shifties and that kind of stuff, but sometimes it's really insightful to employees to quantify that. Because employees, when asked how much, so if you make $100 in sales and you ask an employee how much of that they think usually is left over for the business, their numbers are usually somewhere between 40 to 70%. So they really don't know all the other costs that go into running a business. And it's a fine line of what you choose to share or not. But I think something as simple as just starting to have more awareness over where the comps and discounts are coming from can be super helpful. They also reallocated their advertising dollars. There's a lot of good sessions on marketing here, really rethinking where you're putting your money and focusing on the customer communication for the people that you really want doing business with you, and doing more team incentives for cross-selling and upselling. I've had a number of clients that have been doing different things for trying to move merch or trying to move to go, and it's been successful because you're getting them to bought in. You really have to understand your culture at that point to know what's going to work well to incentivize them without creating unintended consequences too. But they also set KPIs, key performance indicators, that they started looking at on a weekly basis. And this is something that you can do. We've got some simple Excel sheets that we use in addition to POS data that we put in front of our staff at their staff meeting every week. Or if you're not doing it with your full staff, if you're doing it with just your shift leads or department leads, that kind of thing. Just to start tracking things such as average value of a sale. And that's a key indicator when you are running tabs, to really see how much people are spending in one sitting. And there's a lot of good stats. If you haven't heard Secret Hopper, he's based out of Virginia, Andrew from Craft Beer Professionals. And they do a lot of great stats on taproom statistics so that you can look at where is the average spend right now based off of age and demographic, and you can start to compare that to what you're seeing in your taproom. I will say that Toast is one of the POS systems that's really good at putting that on their sales summary dashboard to put it in front of you all the time. So when they did all these things, what happened? This was the result. Now it's not going to be overnight, but it is gradual. Their active customers dropped, and that's okay. You don't necessarily need to do business or want to do business with everybody. You want the people that value what it is that you're offering. And what often happens is when that active customer base reduces, your average sales within the customers that you're working with will increase, and it outweighs the loss. So you can afford to actually lose customers because the ones that remain will actually produce better. It's the same thing that sometimes you'll notice if you've got a not so great employee that's making the environment a little bit toxic, and once you remove them from the equation, how everybody just breathes a little bit better and all of a sudden there's more production. It's that same kind of, you're just getting a little bit more oxygen flowing. So ultimately the gross profit per customer rose, and we go from 2018 being about 120,000 profit margin down in 2020 to roughly 24,000. Back in 2022, 2 years later, they were able to exceed where they had been in 2019. And so everybody's results are going to differ, but it can be that powerful depending on your situation and the results that you're trying to achieve. But ultimately, by 2023, they were back to doing better on a net profit basis than they were in 2018. So the idea behind this and the goal in sharing it is that by changing the focus of who you're working with and how you're working with it, you're more efficient and you make more money. And that ties into a lot of what they were talking about this morning in focusing on your customer experience and defining, what you want to offer, and creating the environment that makes people want to come in, where people are engaging, and ultimately everybody wins. And also in changing who you target within that, you're attracting your customers that really value what you have to offer. So some different things to think about there. Now we're going to jump a little bit, and then I'm going to save all the questions for the end to make sure that we can get through the meat of this. Cash flow. So cash is king. What usually ends up happening is we have some insufficient cash, which is what's been happening a lot more frequently. Can't pay the bills, and it ultimately goes to business failure. So it doesn't matter. It doesn't matter how good anybody is or any system is. If you don't have cash, it's going to be difficult to survive. So one of the things that we're also trying to change the perspective on, and this is a bigger society perspective, is that just because you're a business owner does not mean that you have a bottomless reserve of cash, as you all well know. So it's trying to educate people a little bit more without being negative, that there are reasons that we are paying attention to efficiency and running the business in a different way, and it's not about that we don't like people or we don't care about people. It's that sometimes because cash is that bottom line, we need to pay attention to the factors that drive cash. So the key requirements of your cash flow. Some of the stuff isn't going to be new, and it's pretty common sense, but I'm going to put it out there to preface what we'll go into after that. Of course, your cash flow needs to be positive. There will be times, though, that it's not going to be, and that is part of business. Especially in this industry, you're going to have seasonality where not all 12 months are going to be positive. But it's planning for that and adjusting for it and putting things in reserve, having that slush fund or a backup line of credit to cover those months where it isn't quite positive or available. So that's really what we're looking at, is when the cash flow isn't available, what are the other sources of cash that can help you cover those shortfalls. And we're looking at what do you have in liquid assets, and that's not just liquid beer, but your inventory is something that can be converted to liquor in many, or converted to cash in many ways. Actually, one of the things that I've been really intrigued by, I'm part of the Pink Boots Society, and I've been participating more in the Virginia chapter lately, and we just did an educational session with one of the distilleries, and they were talking about how they've started to ramp up their production by working with breweries to not dump their beer. So let's say you have a batch that you did, and their example was there's a brewery that does a stout every December, and if that batch doesn't come out exactly the way they want it, rather than dumping it, they sell it to the distillery, and the distillery makes a farm of whiskey from it. And we tried an IPA whiskey, so you know that's part of all of this, is thinking outside of the box. Don't go dump the beer. What are the other ways that you can turn that, and it's not even waste at that point, it's not sellable in the form that it's in, but how can you still generate cash from it? So we're looking at what's liquid assets in that you can convert to cash within a 6-month period. So all of your inventory really. And then your cash flow needs to be timely. We want to adjust the flow so that cash is going out when cash comes in. And often this is one of the things that gets a lot of people in trouble, because the timing of cash flow in business doesn't always jive with what people like to do on a personal basis. And it's absolutely not just okay, but really necessary to defer the timing at times of when you pay a bill to match when the cash is coming in that's related to that. I'm going to talk about some quick examples. So when we look at the components of cash flow, we're looking at all the different ways that you get cash. Of course, the greatest is going to be sales. It's also going to be collecting on your receivables. It's going to be through any type of borrowing that you've got or capital contributions, and then looking at your equipment that you sell off periodically to bring cash in. Those are pretty much the core areas. Then we're going to be looking at the cash that goes out through all your operating expenses, through all your capital purchases, whether that's equipment or all the taproom stuff, any of your debt repayments, and then ultimately whatever the owners are able to take out in distributions. So my advice is, in general, have some type of rolling 6 to 12 month cash flow forecast. I've told a few people this. I, as a joke, got a magic 8-ball that I keep on the desk of one of my offices, because at times, especially with trying to track where hospitality spending is going to be these days, it's a magic 8-ball, and we can't forecast because we don't know what the patterns are going to look like. I think that that's okay to know. A lot of people really want to plan out far, but because and in general as a financial practice, a 3 to 5 year forecast used to be a bigger thing. Now I'm really leaning towards, don't set yourself up for failure. Go 6 months tops, because so much is changing in this industry, and do it on like a weekly, you can do it on a monthly basis, but more likely do it on a weekly basis, and it doesn't have to be super intense or time consuming. It can be as simple as just what I showed before, 5, 10 line items roughly, that just start to rough in where you think it's going to put you week to week, so that in 6 months, worst case, you're going to have a cash flow where you're not going to be able to meet something because you know that you're heading into a slower season. You can plan for it. So the goal with a very rudimentary cash flow forecast is trying to determine what your cash that you need is before you're going to need it. The other thing is that you can time, you can do a lot of things with that data to help time the cash flow. So one of the things that people have done in the past is pre-sell kegs. So if you know that you're going to have a cash shortfall in a month, and you know that you've got a beer slated for production in 2 months, you could go to some of your accounts or the distributors or however you're doing it and say, hey, we're going to have this on tap are you willing to commit by buying that ahead of time, so that you can plan for it? That's something that not as many people take advantage of, but you certainly can. You can do the kick the keg. You can do all sorts of other promotions that can help time your sales, or the time the cash coming in, to start to even out the shortages over time. But overall, this is also going to help you when you're going to the bank, rather than last minute needing a line of credit or a credit request. You can say, hey, in a couple of months we know we're going to need it. You can start working to find your options now. But you can also start to build in your own slush fund by knowing, okay, we're going to have, $5,000 extra after this week. We're going to park 50% of it over in this little savings account for us, and that's going to start to build our rainy day fund. And we're only going to touch that when we can be our own line of credit in a way. So, you could adjust it and then track it. And it doesn't have to be something that most of the time when I say this, people are just like, that's too overwhelming, I have too much else on my plate. So whether you do it, or whether you get your bookkeeper to help with it, or your CPA, or whoever's helping you, it can be rudimentary. It doesn't have to be overwhelming, just something getting it on paper. To be fair, QuickBooks Online, not so much, but if you use QuickBooks Desktop, it'll even do a little rudimentary cash flow forecast. But most of the point of sale systems will help you start to forecast your sales based off past data. So there's lots of different tools and resources that you can use. What you're going to want to do when you do it is to estimate your cash sales. So this is paying attention to what your trends are and looking at it on a comparative basis. Looking at the trailing past 4 weeks and what the behaviors have been, not just as a whole, but even starting to track different peers, or even the food breakdown, or whatever your full menu looks like, not just beer related, but you start to estimate what your cash sales are based off of trailing 4 weeks, last year, same month, 3 to 5 years, or however much history we've started comparing. So, right now we would be looking at February of 25. It would be worth comparing February 25 to 24 and 23, but also against January. And, there's lots of different ways that you can look at the data to start to estimate. Then you start to go through and say, okay, when are we going to pay it? Use your terms. Don't pay things immediately when you get them. Work with your vendors over due dates. There's a fine line where you don't want to have a bad relationship with a vendor because you can't pay a bill, but we know that it's happening, and that most people are willing to find different ways of working with it. One of the big things that I've been working with some of my breweries on is with their hop contracts and using a line of credit to, rather than putting in the hop deposits with the vendors themselves, because that can be really expensive, or instead of paying storage fees, you use a line of credit. You talk to the bank, because oftentimes they can take security in the raw materials. They can't always take security in liquor, but they can take security in the raw materials, and then you pay off that line of credit as you're pulling the hops to sell to make the beer. So it helps even out the cash flow based off of when you're buying. So you start to estimate your different expenses in different areas, and you look at those things, and then you can start to plan for, okay, what's going to be the most ideal time for a capital purchase, and how can we finance that? Making sure that you're trying to finance as much of those things as possible rather than using up your own cash flow. And recruitment needs, salary benefit increases, that kind of thing, and of course the good old taxes that always comes into play. And then you're looking at working with marketing, like I talked about, pre-sales, naming rights for different things. That's come into play quite a bit, where even some regulars are willing to pay an extra fee. One of my clients that's in California, they've had a lot of success with selling tickets to theme nights, and so it's a limited attendance event to some extent, but they're selling a ticket to it to get in that then adds to the revenue of whatever beer, and they do beer and cider, whatever they're able to sell that night. So you can do naming rights in various forms. They had people that bought naming rights for some of their barrel aged, for some of the barrels for aging. Scheduling, look at how your scheduling your production scheduling is affecting your sales. You know, if you're going into a season of tighter cash, that might be the time to make sure that you've got those quicker beers that can be produced so that you don't have, you're not sitting on a bunch of cash in tanks for a longer period of time. Looking at your different pricing structure based off of volume and season. So we've talked about the line of credit a little bit. And just get creative. There's so many different ways that oftentimes we're so used to the way we've done things in the past that we forget that there are other ways. We want to do legal, of course, but think creatively and definitely engage the help of professionals to help look at things a little bit differently. That may come in an investment, but it's a worthy investment if they're providing a return that exceeds what you're having to pay for them. That's what I always tell people for a CPA, is that ultimately the value that we provide, short of prepping a tax return, should help grow your business through thinking about things a little bit differently. Working capital management. So managing your non-liquor receivables, payables, and inventory. I've had a couple of people that have gotten in trouble because their inventory was eating up so much of their cash. And when we really started tracking how much they were sitting on in their tanks and the length of time that it was taking to turn some of the tanks, as well as how much they were ordering, because there's a fine balance of ordering to get a discount, but then having to sit on it for a while. So paying attention to those things and trying to use what we call a line of credit for that working capital to some extent. You know, if you absolutely have to have a huge can order, use something like a line of credit for that. Talk to the banks, and you know, it's hard. Banks aren't often keen on doing lines of credit for our hospitality business, but it doesn't mean that it's impossible. And debt isn't bad when used effectively. That's the biggest thing, is that it can get people into trouble. But it's a matter of how are you using it, managing the interest rates behind it, and there's a huge difference between tax deductible and non-deductible debt, and we often hear that these days. In business, pretty much all of your debt is going to be tax deductible. So using credit cards to the extent that you need to give sources of additional financing, not a bad thing. My general rule is, and this is my personal opinion, you measure your interest rate against your tax rate. And as long as the interest rate you're paying is less than your tax rate, you're going to be money ahead, because without having that interest and you're using up your own cash, you're just taking that same percentage and paying the IRS or New York State. And people really, we've seen numerous articles on the personal side about this, but bringing it back to business, because a lot of personal finance, you know, try to pay off debt as quickly as possible, but in business right now and with cash flow, it's actually the reverse. You just want to use it effectively. So a couple of other things with cash flow, really quick, would be you need to work on the drivers of cash flow. So you look at your processes around receivables. Who are the suppliers that you're working with, and what are their terms, and can you get different terms with different people, or can you work with them because of relationships? We talked about inventory, assets, really looking at the sales patterns and sales volume, which is, you know, how are you using your point of sale, and what can you get out of it that you're not already getting out of it? Cutting costs versus increasing turnover. No business ever shrank its way to greatness. I think that's a really big thing to keep in mind. And it's a tough one, and I completely can empathize as a business owner myself. It's hard to make an argument of we need to invest X amount right now when our cash is already super tight, or that means that sometimes if you're gonna make an investment, that somebody, like one of the owner's paychecks generally has to be put on hold for a little bit, something like that. It's really reevaluating priorities, and going back to something that was said earlier, revisit your strategies and how it's tying into your actions, and is there a discrepancy where you've been so caught up in everything that's happened post-COVID environment and the economy that has gotten you off track from where you want to be. So ask yourself some tough questions at times. The real definition of expenses, I think the thing that I want to express most here is that reframe expenses in terms of investment rather than a cost to you. And that can help change the mindset in how you approach it. So if you focus on what is the investment and how does that relate to the return on investment, you can start to approach problems or costs a little bit differently. So labor, you're investing in the people who want to help you. I think that gone are the days where automatic pay increases without merit or other reasons are gone, that we're going to be going back to, really looking at who you have on the team and making sure that the value behind their position and is clearly communicated. So, for example, a tap room employee, you're hiring them so that they can be the face of your business with your customers. They're there to engage in them, to engage with your customers. They're there to educate them. It's not just to help them pay their bills. It's making sure that they have the resources to tell your story to the people that you want buying your products and services. So really focusing on investing in the people who want to help you. And the people that aren't quite on board, either invest in the resources to get them on board or perhaps start to transition them out, but making sure you've got a good team. Vendors, the same thing. Invest in companies that are adding value to what you do. Compliance, definitely you have to do. There's a lot of things for liquor reasons and regulatory reasons that you have to do, but it can have a value add if you look at some of the benefits that some of those requirements can offer. I get that, especially taxes. It's a compliance cost that most people hate, but it also requires you to track information that can certainly be beneficial if you look at it in a different way. The last thing that I want to mention here that's been a topic of conversation heavily right now is merchant fees, because there's been a huge conversation over passing those merchant fees on to the consumer and the whole idea of service charges. And every state regulates this a little bit differently, and I didn't double check because I added this piece in at the last minute what New York's current rules are, but merchant fees originated as a way for people to use credit cards to pay you, to do more business with you, and to pay you faster. It's morphed now where credit cards are the most common form of payment. It is the cost of doing business, and it is an investment that you make in order to increase the ability for people to spend more with you and get that money a little bit faster. You wouldn't charge them to pay you cash. So charging them to now pay you in the most acceptable form of payment might be also undermining your ability to get sales. So rethink your merchant fee. I personally think that it's something that we either have to have our prices cover itself. So if your merchant fees are going up, increase your pint cost rather than add that incremental charge, because it's the mindset of the consumer. Every single one of us in the room has had delivery charges added in, all these extra service charges from various vendors in our business and personal lives, and we know that we don't like it most of the time, even when we understand it. So starting to rethink that in how we approach it, but I think the biggest thing is that your bank charges you for cash and check deposits and always has. Most people don't understand it, but every bank does. So you don't turn around and charge your customer for that. Why are we doing that now with merchant fees when it's the most acceptable payment? So anyway, you can try to figure that into your cash flow, because I also think that that's has a huge effect on sales that people aren't paying attention to yet. Okay, so the last couple of things I want to cover before we run out of time is, and we've kind of talked a lot about the cash flow, so I'm not going to go through the summary here, other than leverage effectively. That's probably one of the biggest pieces that I would suggest right now. But really, it's not always a numbers game. Part of going out of business or looking at where your business is at and it's struggling about is, what are you spending your time on and where is that mindset at? Sometimes it becomes a self-fulfilling prophecy when you're so immersed in the negative and you're seeing numbers that aren't so great. It can become a self-fulfilling prophecy where it gets you to a place where you can't see opportunity and you can't see other perspectives. So I think being aware of that, and then start to look at what are the mindset and reasonings that we're using. Right now, it's really key with many different generations in the workforce, especially within our tap rooms, the younger generations, where those trends are coming into play. So what should you be spending time on? Definitely the financial data, but really looking at human behavior. And one of the things that I want to talk about is we all bring beliefs and ideas into the workplace. I actually have a master's in consulting for learning human behavior, the way we grow up, the things that we learned within our family structure, the way that we interact with siblings. We bring that into the workplace, and it affects how we work with our customers and our vendors. So all the different ways that we were raised, to some extent, we're going to bring that into the workplace. So if you had tough sibling relationships, then sometimes that can affect how you work with coworkers. It's being aware of it, and also starting to sense that within your employees, so that you can address it and deal with some of the different issues. The other thing is that personal finance strategies often come into the workplace, and while they're well intended and useful in the personal finance arena, not appropriate in the business arena, and that can really cause a big divide with especially employees who don't necessarily understand why you're going to do something a certain way. And so I think putting it out there on the table and having that be part of the team meetings or staff meetings to some extent can really be helpful. But whatever your position is within the business, understanding that. One of the things that isn't always fun, but I think key in maintaining a good business, and I really like Brene Brown, because her thing is curiosity is a shit starter, but that's okay, because sometimes we have to rumble with a story to find the truth. And I think that's what we've been living in, especially post-COVID, is that this is making us, in many ways, reevaluate how we choose to operate in business, what we've been doing for the sake of doing it, and what do we want to do to be happier, whether that's you as an owner taking the financial risk of having money invested in a business that you would eventually like a reward from, or your employees who are coming into work and investing their time and energy into something. So it's not always going to be roses, and when we're faced with a lot of these tough conversations, being able to sit in a meeting and start to look at what our story is and ask some tough questions. And I think what's coming up here is what I call irrational reasoning. Starting to really say, why are there things happening in business? Are we losing sales because there's so much competition? Or is it maybe that our service levels haven't been where they needed to be in order for customers to have that great experience? Maybe we've had a few people that have had some tough days and they weren't able to interact with people in the best fashion. We were having a conversation at lunch earlier. Hospitality can certainly be frustrating, and you deal with a lot of personality types, and you can't punch them or hit them or just get upset. And it's recognizing when you're getting triggered by behavior that's going on, but also how to deal with that without creating an environment that harms the customer experience. So I think really asking ourselves key questions in sales. If the sales are going down by a customer, is it truly because, and it may very well be at times, because of the recession and their spending patterns are having to change? Or are we making some mistakes? Have we been inconsistent? What are we doing that could be contributing to the problem? Oftentimes we're not paying attention to. So delivery times is the same thing. Is it because the supplier failed? Or did we wait too long to try to order it so that yeah, they normally could turn it around quickly, but now they've got their own issues and they needed to have a little bit more lead time. So I think asking ourselves some of those tough questions and being ready to handle those responses can really be a game changer. Errors. So these are some of the things that are the hot topics right now, the whole concept of quiet quitting. Is it because hospitality is no longer super fun? Oh, there's my warning on time. Is it because hospitality is just not fun and customers are hard to deal with? Or have we not taken the time to have some conversations to address concerns and performance expectations and results? Often there's definitely something to be said about the changes in where hospitality is at, but I think that there's things that are hitting at both ends, and often we fall to what's the easier option, that there's an external factor rather than what our internal factors are, especially communication, because somebody didn't tell me, or is it because we didn't take the initiative to ask the question or have reasonable expectations? One of the biggest things that's come up lately is, was there expectation without agreement? Whether that was from a customer that came in and expected you to have something that you never agreed to, or same thing with an employee. Is an employee expecting you to do something that you never agreed to? Or are you upset at an employee because you're expecting something of them that they never agreed to? So really paying attention to expectation without agreement or with agreement, and starting to close that gap through more communication. That will heavily impact your numbers more than you realize, whether that's just the volume of business or the volume of, volume of business really, or dollar values. Too much happiness, too much focus on a positive environment will often foster complacency. And that's another difficult piece for people to grasp at times. So you don't want to train people to consistently avoid conflict. But what you do need to do is set the environment so that you can have a healthy conversation without it leading to something that escalates, and without attacking character, not shutting down imagination. That's huge. But I think really being able to say what needs to be said in a healthy, respectful way is huge. And what it means is, when we have an environment that will ask and tolerate tough questions, we're better able to weather the storms that are going to come through. We're going to take a constructive approach to questions and criticism. Always have or create an environment that adapts a perspective of understanding. And one of the other key things is, it's been said that we tend to judge others by their actions and not their intentions, yet we usually want to be judged by our intentions and not our actions. So I think putting that out there to our teams and say, hey, wait a second here, let's make sure we're all on the same page, recognizing it within ourselves, because we all do it at times, recognizing it within ourselves and then recognizing it in others, and being able to put some safety measures in place to be like, hey, wait a second here. You can have a safe word, if you will, that, hey, this is when I feel like we're starting to judge based off of something that we didn't agree to. Be very careful with assuming, and I think that goes at all levels of the organization. That was something that my dad taught me early on, is the acronym for assume, which I'm sure many of you probably have heard too. So be careful with that. Choices equal consequences equals choices. And I think reiterating that, it's to some extent, think back to parenting if you are a parent. If you're not a parent, then you can relate to how others parent, or even with animals, because usually you may not have kids, but you may have an animal that you're a parent to. But there's always consequences for choices, and we just have to be a little bit more aware of it and then what we want to do. The last piece that I want to touch on before we end are some of the recent trends in fraud, because that is affecting our tap rooms and it's affecting our business in a more serious fashion than a lot of people are talking about. And the piece that's really kind of scary is that right now the latest fraud studies that have come out by the American Certified Fraud Examiners are that the younger generations, their definition of fraud is completely different. They grew up in an environment where fraud doesn't mean the same thing, and they not only feel that they are entitled, but it is expected that they have rights to take things that normally would have been stealing in the past. So that line that we've walked in the past is now blurred. And there's a little bit of a double standard that's coming into play where they want to work for the younger generation, specifically the millennials, want to work in an environment that is highly ethical and moral, but they don't believe that they need to uphold themselves to that same standard. And that's a very scary place to be. What it means for fraud and hospitality and how you run your business and what would affect your ability to stay in business is paying attention to your cash on hand. It escalated with COVID. Believe it or not, even with people not doing as much cash, unrecorded or understated sales, which often means that you're mixing your sales with tips, stuff that's still going in people's pockets, paying attention to your voids and refunds. That is still a way that people will. We had a fraud in our town where one of the managers was going in and changing credit card tips on credit card sales before the batch closed at the end of the night. So the customer would have gone in and set a specific tip on the credit card, but because the batch wasn't closed, she would go in and edit the tip before the batch closed, and then she had signature authority on the bank account, so when those credit cards were getting deposited, she was pulling out that extra money. Just paying attention to it, owner oversight for sure, or having somebody else that's paying attention, making sure your internal controls with your point of sale, people are not sharing codes, you don't have your manager sharing logins, that kind of stuff is huge. Inaccurate clock-ins and personal time. We have had this quite a bit, especially if you've got mobile time clocks, because again, it goes back to, they don't think there's anything wrong with clocking in a half an hour when they leave their house and they're driving to work, because nobody's going to catch it. And they also don't think it's a problem. So paying attention to inaccurate clock-ins and personal time on the clock. Personal charges on a company credit card lately has been a huge one, where they just, think that people aren't paying attention, but also that that's just a benefit that they should be entitled to. So just note that's out there and put procedures in place to help eliminate it, because again, that's cash out of business pockets. Primary weakness, lack of controls is the biggest thing. Override of controls. I can't tell you how many times I'm told that, oh, well, the manager gave their POS PIN code so that this person could override. Don't allow the overrides. Lack of review or tone and talk. That's pretty much, if you're interested in some of this other information, I can send you some of the details, but know that there's definitely paying attention to behavior and generational differences. Is a red flag. You know, it's not a bad thing. You have to be careful with a lot of HR rules now, but if you're noticing different things going on with employees, ask the questions, have the conversations before something worse happens. Right now, what's interesting is that this was from 2022. This was the average fraud based off age. Right now, 31 to 35 as of 2024 went down, but 26 to 30 skyrocketed by more than double. So again, it goes back to expectations, and it's, again, I put it out there because it does have an impact on your ability to stay in business and how you stay in business. So ultimately, how to manage more effectively. Understand your numbers. Okay, perfect. This is at the end. So thank you very much. I hope you had some valuable information and be accountable.